China's economy isn't just pathetic, it's collapsing, fast, loud, and in full view of the world. The unstoppable superpower we were told would dominate the 21st century, it's crumbling from the inside out. Ghost cities, sky-high youth unemployment, a shrinking, aging population, and now a housing market so broken that over 90 million homes sit completely empty, enough to house the entire population of Spain. This isn't a slowdown, it's the spectacular unraveling of a $52 trillion inventory bubble, built not on value but on debt, hype, and deception. At 3:25 p.m. on August 27, 2021, 15 high-rise towers in Kunming were reduced to rubble in a perfectly synchronized explosion. No war, no natural disaster, just buildings no one ever needed, collapsing under the weight of their own uselessness. It wasn't just a demolition, it was a preview. So how did China go from economic miracle to real estate graveyard? First up, the bubble that changed everything. China's real estate sector accounts for nearly 30% of its entire GDP, according to the International Monetary Fund's 2023 country report. Almost a third of their economy is tied to building apartments and commercial properties. But here's where things get alarming. Housing prices have plummeted since 2019 with no bottom in sight, according to Reuters data. Major developers like Evergrande and Country Garden have collapsed under hundreds of billions in debt. Unlike Americans who invest in stocks or retirement funds, about 70% of Chinese household wealth is tied up in property, according to a 2023 survey by China's National Bureau of Statistics. When housing prices fall, families don't just lose investments, they lose everything. In cities like Shaoguan, entire districts sit half-finished and eerily uninhabited, a stark symbol of China's unraveling real estate crisis. This isn't just a correction, it's a $133 trillion property market cracking under its own weight. The property crisis has sparked unprecedented resistance. In over 100 cities, homebuyers have launched mortgage boycotts, refusing to pay loans on unfinished properties. Social media footage shows crowds chanting "Return our money" outside bank headquarters. And this public discontent coincides with the shocking revelation that undermines China's entire economic narrative. China lied about its population, not by thousands or millions, but by over 130 million people. According to Professor Yi Fushuan, a leading expert on Chinese demographics, the government has been overestimating its population by at least 10%. That's the equivalent of inventing an entire country the size of Japan. Why? Because bigger population numbers made China look stronger and more productive on the global stage. It artificially lowered their GDP per capita while making their military power appear greater. China wanted to project strength, says Yi. Artificially inflated population figures made their economic miracle seem more miraculous. The truth is now emerging. In 2022, China announced its first population decline in 60 years. But according to Yi's research, the decline actually began in 2018, 4 years earlier than officially admitted. What's worse, China's birth rate has now fallen below Japan's, a country famously struggling with demographic decline. Recent data from Statista shows China recorded just 6.77 births per 1,000 people in 2024, nearly 50% below replacement level. But wait, didn't China end its infamous one-child policy years ago? They did, in 2016, but the expected baby boom never materialized. Young Chinese couples looked at sky-high housing costs, brutal work hours, and expensive education requirements and simply said, no thanks. The government's desperate measures, from baby bonuses of up to 10,000 won to propaganda campaigns with slogans like "marriage and reproduction are family responsibilities," have failed to reverse the trend. According to projections from Visual Capitalist, China's population could shrink by half by 2100, dropping from 1.41 billion to around 600 million. That's equivalent to losing the entire population of North America. The Shanghai Academy of Social Sciences put it bluntly in their 2023 report. China's demographic collapse is not a future event, but a present reality. This isn't just a statistical curiosity, it's an economic death sentence. The irony is brutal. China spent decades enforcing a policy to have fewer babies, and it worked so well that now, even when they're begging citizens to have children, nobody's listening. As one Chinese demographer told the Taipei Times, the one-child policy fundamentally altered the cultural understanding of family size. You can't undo that with policy changes. China's working-age population peaked in 2015 and has been shrinking for nearly a decade. By 2050, China will have 200 million fewer workers, more than the entire U.S. workforce. This workforce collapse is creating labor shortages that undermine China's competitive advantage. Factory owners in Guangdong and Zhejiang provinces report raising wages by 30 to 40% just to attract workers, destroying China's edge as a low-cost manufacturer. The demographic crisis creates a perfect storm. China is getting old before getting rich. Currently, about 14% of China's population is over 65. By 2040, that will nearly double to 30%, almost 1 in 3 people. A country with more grandparents than workers faces an impossible economic equation. According to a 2023 report from the Chinese Academy of Social Sciences, China's main pension fund will run out of money by 2035. Xi Jinping himself acknowledged this in a rare moment of candor, reportedly calling the demographic situation the most significant hidden danger to national security. The social contract that has kept China stable, rapid economic growth in exchange for political compliance, is breaking down. Who will staff the factories, buy the apartments, or pay for the health care and pensions of hundreds of millions of elderly Chinese? As if the property collapse and demographic crisis weren't enough, China's economic model faces a third existential threat: debt. China's overall debt has now surged past 300% of GDP, according to 2024 figures reported by the Economic Times. For comparison, the United States, hardly a model of fiscal restraint, hovers around 120%. The economic growth that impressed the world wasn't built on innovation or productivity. It was built on borrowing. Every time growth slowed, the government ordered more construction, more apartments nobody would live in, more infrastructure nobody needed, more factories with no orders. Former Chinese Finance Minister Liu Jiwei acknowledged this reality in a speech at Tsinghua University. Our economic growth has been primarily driven by investment, not by productivity or innovation. This model has reached its limits. Local governments are the canaries in this coal mine. Collectively owing over $9 trillion in debt, they've relied on selling land to developers as their primary revenue source. With the real estate market collapsing, that revenue has disappeared. The desperation is palpable. The city of Nanning sold police cars. Tianjin auctioned government furniture. Henan province tried forcing civil servants to buy unsold apartments. According to Economic Times, some cities can't pay salaries, while others are paying workers in groceries instead of money. Banking expert Michael Pettis from Peking University notes, the debt situation at local levels is far worse than officially reported. Many liabilities are kept off the books through local government financing vehicles. The debt crisis coincides with record youth unemployment that Beijing can no longer hide. Youth unemployment hit 21.3% in June 2023, a figure so alarming that China's National Bureau of Statistics suspended reporting it while they improved their methodology. When reporting resumed, the rate still hovered at 18.8% in August 2024, before dropping slightly to 17.6% in September. That's 1 in 5 young Chinese unable to find work in what was supposed to be the world's economic powerhouse. College graduates are calling themselves full-time children, moving back in with their parents. Others describe lying flat, giving up on career ambitions entirely. As one recent graduate told the BBC, "I studied so hard to get a good degree, but there's no future. I've sent out hundreds of applications and heard nothing back. What's the point anymore?" This generation has coined a new term for themselves, rotten tail kids, drawing a parallel to the unfinished rotten tail buildings dotting China's landscape. They spend 16-hour days studying for civil service exams, where 1.5 million applicants compete for just 37,000 government jobs, odds of just 2%. As young people lose hope, global companies are fleeing China in what economists call the Great Decoupling. Foreign direct investment continues to slide, with global manufacturers accelerating their pivot away from China. Chip makers like Intel, Infineon Technologies, and Micron Technology have poured billions into new facilities in Malaysia and Singapore. HP has expanded its laptop assembly operations in Thailand over the past 3 years, while factories in Malaysia's Penang state now produce cutting-edge AI servers. As a result, Malaysian exports of semiconductors, computers, and other electronics hit a record $137 billion in 2024, with the surge in shipments to the U.S. Meanwhile, China's dominance in notebook production is beginning to erode after accounting for nearly all global output just a few years ago. Its share is projected to fall to 80% in 2025 as Vietnam and Thailand pick up production. This shift marks more than just a supply chain adjustment. Companies that spent decades building their presence in China are now scrambling to get out, says economist Mary Lovely of the Peterson Institute. We're witnessing the most dramatic industrial migration in modern history. Why this exodus? Rising labor costs without rising productivity, arbitrary regulatory crackdowns, intellectual property theft, and a consumer market that's shrinking instead of growing. China's tech sector, once the crown jewel of its economic ascent, has been severely impacted by government interventions. In 2021, a sweeping regulatory crackdown led to a loss of over $1 trillion in market value among major tech firms. Jack Ma, the founder of Alibaba, notably vanished from public view for months after criticizing financial regulators. Even foreign tech companies weren't spared. LinkedIn and Yahoo both withdrew from China that year, citing escalating compliance costs and an increasingly challenging operating environment. This aggressive stance signaled a clear message: political control takes precedence over economic growth. Consequently, venture capital investment in Chinese tech firms has plummeted by 87% from its 2018 peak. These developments underscore a deeper issue: the faltering of China's ambitious Made in China 2025 initiative. Launched in 2015, the plan aimed to transform China into a global leader in high-tech industries, reducing its reliance on foreign technology. However, studies indicate that while the initiative funneled substantial subsidies into targeted firms, it failed to produce significant improvements in productivity, R&D expenditure, or patent output. One of the most high-profile targets was the electric vehicle sector. Despite pouring over $100 billion into the industry and spawning more than 300 EV manufacturers, China's auto sector still depends heavily on foreign core technologies. In response, the government has quietly pressured firms like BYD and Geely to ramp up purchases from domestic chip makers, a telling sign of how far China remains from achieving technological self-sufficiency. The semiconductor initiative is even more revealing. The Big Fund, China's $50 billion semiconductor investment vehicle, has yielded disappointing results. In 2023, several of its executives were arrested for corruption. HSMC, once touted as a homegrown chip-making giant, collapsed after burning through billions. Meanwhile, China's most advanced chip producer, SMIC, remains stuck at 7-nanometer technology, while global leaders have already moved on to 3-nanometer and beyond. This technological dependence creates an existential vulnerability. When the United States restricted high-end chip exports to China in 2022, it effectively capped China's AI development, military modernization, and high-tech manufacturing ambitions. China's innovation model fundamentally misunderstands how technology advances, explains Dr. William Hannes of Georgetown University. They've emphasized massive capital investments and targeted goals, but innovation requires an ecosystem of intellectual freedom, risk-taking, and failure tolerance that China's system actively suppresses. Equally concerning is China's shadow banking crisis that threatens to detonate at any moment. Behind the official banking system lies a $3 trillion shadow banking sector, a complex web of wealth management products, trust companies, and off-balance sheet loans. This parallel financial system helped fuel China's growth but created massive hidden risks. In 2023, Zhongxi Enterprise Group, managing over $140 billion in assets, suddenly announced it was insolvent. Country Garden, once China's largest developer, defaulted on overseas debt. Both events sent shockwaves through China's financial system. More alarming are the bank runs that rarely make international headlines. In 2024, depositors lined up outside rural banks in Henan province after discovering their deposits, totaling $6 billion, had vanished. When they protested, local authorities manipulated their COVID health codes to restrict their movement, turning public health tools into instruments of financial repression. China's financial system is built on implicit guarantees that the government will never allow significant losses, notes Logan Wright of Rhodium Group, but as more defaults occur, that confidence is eroding rapidly. The real warning sign came in July 2024, not from a collapse, but from a historic plunge in bond yields. As money fled China's collapsing real estate market and volatile stock exchanges, investors piled into government bonds, sending prices soaring and yields to record lows. The benchmark 10-year bond yield fell to just 2.18%, its lowest level since records began in 2002. This rush into perceived safety reveals a deep lack of confidence in the broader financial system. These financial tremors expose another critical weakness: the widening divide between China's prosperous coastal regions and its struggling interior. The gleaming skylines of Shanghai and Shenzhen mask a stark reality. Much of China remains poor, with regional inequalities worse than any other major economy. The per capita GDP of Jiangsu province is 3 times higher than that of Gansu. This disparity has worsened over the past decade. The COVID pandemic exacerbated these divisions. While coastal tech hubs recovered quickly, interior manufacturing regions dependent on exports struggled to keep pace. In 2023, Yunnan province grew by just 4.4%, well below the pace of leading coastal cities. Beijing, by contrast, posted a stronger recovery with GDP growth exceeding 5%. This regional inequality creates dangerous political tensions. In 2023, protests erupted in Wuhan, where COVID first emerged, not over health resources, but in response to signals from Beijing that it would not bail out debt-laden local governments. The demonstration reflected growing frustration with the financial fallout of China's strict zero-COVID policies and the widening gap between struggling interior regions and wealthier coastal cities. In resource-rich Inner Mongolia, resentment continues to build as locals watch their coal and rare earth minerals fuel Beijing's economy, while environmental degradation remains local. China isn't one economy but several different economies moving at different speeds, explains economist Barry Naughton of UC San Diego. The coastal innovation economy, the interior manufacturing economy, and the Western resource economy are diverging rather than converging. This fragmentation undermines Beijing's ability to implement coherent economic policies. Stimulus meant for productive investment often gets captured by wealthy coastal provinces, while austerity measures hit the interior hardest, further widening disparities. But perhaps nowhere is China's economic mismanagement more evident than in its environmental crisis. Why should you care about China's problems? Because when the world's second-largest economy unravels, the shockwaves will hit every corner of the globe. China is the largest trading partner for over 120 countries. It controls 85% of global rare earth processing, manufactures 80% of the world's solar panels, and produces 76% of its lithium-ion batteries. China's economic problems represent the single largest threat to global economic stability today, warns former U.S. Treasury Secretary Larry Summers. Next, global shipping and commodities markets will convulse. The Baltic Dry Index, measuring global shipping costs, has already dropped 37% since January 2023 as Chinese imports decline. Iron ore, copper, and coal prices would crash, devastating resource-dependent economies from Australia to Brazil. Manufacturing supply chains will fracture by the third quarter of 2025. Companies dependent on Chinese components will face critical shortages. Inventories of high-tech components have already fallen to alarming levels. By early 2026, financial contagion will spread as Chinese investors liquidate overseas assets to cover domestic losses. Hong Kong's property market would likely collapse first, followed by luxury real estate in Vancouver, Sydney, and London, markets where Chinese investors have been major buyers. We'd see a cascade of deleveraging that would make 2008 look orderly by comparison, explains economist Stephen Roach, former chairman of Morgan Stanley Asia. The healthcare sector faces unique vulnerabilities. China produces 80% of the world's active pharmaceutical ingredients. A sustained disruption could trigger global medication shortages within 120 days. The FDA has already identified 63 critical medications that would be affected. European economies face particular exposure. Germany sells 33% of its automobiles to China. French luxury conglomerates derive 35% of their profits from Chinese consumers. Italy's high-end fashion houses count on Chinese tourists for 20% of European sales. Then, manufacturing supply chains would break. Everything from smartphones to automobiles requires components made in China, components that might suddenly become unavailable. Financial markets would follow. Chinese investors desperate for cash would sell foreign assets, triggering market crashes from Asia first, then Europe and America. The $61 trillion in Chinese bank assets, many of dubious quality, would be called into question, potentially freezing global interbank lending. But what's truly terrifying about this situation is how the Chinese government might respond to economic collapse. History shows that when authoritarian regimes face internal crises, they often look for external enemies to blame. There's a direct correlation between China's internal economic stress and its external belligerence, explains Dr. Elizabeth Economy of the Hoover Institution. China's increasing military aggression and threats against Taiwan aren't happening in a vacuum. They're the desperate actions of a regime that knows its economic narrative is collapsing. The warning signs are already visible. Naval encounters in the South China Sea increased by 50% in 2024. Chinese military aircraft incursions into Taiwan's air defense zone jumped from an average of 5 per week to over 20. Satellite imagery shows unprecedented military buildup along the coast facing Taiwan. Internal Chinese Communist Party documents leaked to Australian intelligence in March 2025 revealed contingency plans linking severe economic distress to decisive action on territorial integrity issues, a thinly veiled reference to Taiwan, Hong Kong, and disputed territories. Unlike previous declining powers, China has nuclear weapons, the world's largest army, and a leadership structure that fears losing control above all else. The combination of economic desperation and military capability creates an explosive mix that could lead to catastrophic miscalculation. Former Premier Li Keqiang admitted as much in a leaked conversation with diplomats, saying China's official statistics were man-made and for reference only. He relied instead on electricity consumption, rail cargo volume, and bank lending as more reliable indicators. By those measures, China's economy is already faltering. Electricity usage has flatlined, rail cargo is declining, banks are forcing loans on reluctant businesses. China's economic miracle ended years ago, says Dr. Michael Beckley of Tufts University. What we're seeing now is the lag between economic reality and global perception. China's innovation economy is equally pathetic. Despite ambitious pronouncements about technological dominance, China remains dependent on foreign technology for its most crucial industries. In 2023, China imported $300 billion worth of semiconductors, more than it spent on crude oil. Its AI sector runs largely on NVIDIA chips designed in America, while its electric vehicles rely on battery technology pioneered in Japan and South Korea. And while its aerospace industry has made progress, China still struggles to produce high-performance jet engines at scale without relying on foreign expertise or components. Even China's surveillance technologies depend on foreign-designed chips and algorithms. China excels at copying and scaling existing technologies, notes Dr. Rebecca Fanin, but true innovation requires intellectual freedom and individual rights, precisely what the Chinese system suppresses. The Chinese Communist Party's answer to these mounting crises? Authoritarian control. As economic prosperity falters, the surveillance state expands. China has installed over 700 million CCTV cameras, nearly one for every 2 citizens. Facial recognition, social credit scoring, and digital currency surveillance have become tools to maintain stability when prosperity fails. It's a new social contract, says political scientist Elizabeth Perry of Harvard. Instead of "we deliver growth, you stay quiet," it's becoming "we ensure security and stability, you follow the rules." China has overbuilt generation but underbuilt transmission, explains Dr. Lin Buquang, Dean of China Institute for Energy Policy Studies. They've prioritized visible power plants over invisible but critical infrastructure. The country's energy dependence extends beyond its borders. Despite massive investments in domestic oil production, China now imports 73% of its oil needs, up from 50% a decade ago. This dependency creates strategic vulnerabilities that military spending cannot resolve. And on the subject of military spending, China faces an impossible balancing act between guns and butter. Military expenditures have increased by 7.2% annually for the past decade, even as economic growth has slowed to 4.5% and lower. The People's Liberation Army now commands enormous financial resources. According to the U.S. Department of Defense, China's true defense spending may have reached as high as $700 billion in 2023, far higher than official figures suggest. This prioritization comes at the direct expense of social services and economic investment at a time when both are desperately needed. Flagship military programs are showing the same pattern of overpromise and underdelivery that plagues civilian initiatives. The much-hyped J-20 stealth fighter can't match American or European counterparts in engine performance. The Type 003 aircraft carrier, meant to demonstrate China's naval prowess, has faced repeated delays and technical problems. China's military budget creates a dangerous illusion of strength, notes Admiral James Stavridis, a former NATO Supreme Allied commander. They're spending enormous sums on weapons platforms that look impressive but lack the technological sophistication for modern warfare. So, what do you think? Is China's economic decline inevitable, or can Beijing somehow reverse course? How will the unraveling of the world's second-largest economy affect global markets and security in the coming decade? Let us know in the comments below, and don't forget to subscribe to Fall of Nations for more videos that expose the shocking realities behind today's biggest global stories. Now go watch 17 facts about China's collapse that seem fake but are 100% real, and tell us what you think.